Let's get to our guest. We have Mathieu Chabran joining us here in the Lion City. Your take on how it's looking for China's economy. We're seeing all these measures coming up. Is there a sense of urgency finally or not?
Well, good morning, Linda. Thanks for having me. I mean, there's a lot of things we just heard, in a matter of 5 minutes. It was pretty dense. And a few days after the Fed, action, I think, what we are witnessing right now is that many central banks are looking for some excuses, if I may say, to give a new price to liquidity. I think that what we've been seeing for the past 10 years now, effectively this abundant liquidity everywhere. And when it comes to China, they benefited from a lot of, foreign investments. Now, this money is moving out. Mr. Sorrell just mentioned about, real estate. And, what's happening right now, I guess, is effectively a perfect moment for central bank and for the PBOC, specifically to say, okay, we might not be giving you a new risk premium indication, but we give you a sense, that there is, more liquidity or potentially more liquidity. Let's see whether, this stimulus package, is coming or not. But I think we're coming down to some very basic, finance, corporate finance 1.0 here is effectively what's the cost of liquidity.
The thing is, we've seen massive outflows from China and on the back of that, from Hong Kong. Yet you're here from your trip to Hong Kong, setting up a new office. I mean, what's the thinking behind that?
Well, that's actually at the core of the Tikehau DNA. Create, don't compete. Linda, we opened our office in Singapore 10 years ago at Tikehau. We're celebrating 20 years, this year. And when we came here 10 years ago, a lot of our competitors were actually all in, on Hong Kong. And today, to your point, we see that the flows, the outflows, are very different. And that's when we took advantage of effectively going there. There are many drivers, to that. We're primarily a European-based asset manager with a portfolio of very, very interesting, companies, high growth company who are looking to effectively come into the wider Asian market, Southeast Asia, obviously, but China. It's a very good timing to be offering some alternative, to maybe more historically, maybe some U.S. managers, and the U.S. companies. The whole situation is great for Southeast Asia, I believe. And at Tikehau, we're really looking at the whole market with our presence in Singapore, in Korea, where we've been 5 years, in Tokyo, and now, in Hong Kong, to be able to best serve not only our investors from a capital formation standpoint, but also our portfolio companies and the people that we're invested into.
First, talk to us about the opportunities that you see when it comes to China. The government is really trying to get capital back from the international market, and it is trying to get capital to areas like their innovation, their technologies. I mean, how are you assessing that?
That's right, and that's actually what we've been witnessing for the past 12, 18 months. In our discussion with the large asset owner, in China, who've been traditionally some very big asset allocators, some large LPs. What they're interested right now is no longer just to give you a check and you go, Mr. Asset Manager, and deploy my money, and we'll catch up, in 10 years. What they're looking for is really this two-way flow, where the portfolio companies that we invest into, that we finance globally, but specifically as far as we're concerned, a lot in Europe, could then in return, come back into China to effectively bring some expertise, make up for some part of the domestic slowdown that we are seeing. And the dynamic is very different from what we used to experience. And in that respect, we think it's a great timing. And what has been happening between China and the US and this overall dynamic is certainly creating for many of us, here in Singapore, in Southeast Asia, ourselves, in Europe, to take advantage of the whole
But the question is, do you trust China's move? Do you trust its policies will remain the same? It's been going out to say that, we want to ease the curbs on IPOs, for example. Is it enough to encourage you that, the environment is changing and it will stay that way?
Oh, I mean, the reality that at the end of the day, the market is always right? And what we've been seeing lately is that, speaking of the IPO market or others, even the debt capital market, and we all know that the property segment has been the biggest beneficiary, of this debt ballooning. We know that right now the capital markets are fairly inefficient, right? I mean, on your program earlier on today, they were talking about IPO in the whole region. And we know that, the equity capital market, the debt capital market has been, less efficient than they used to be. So that's where, the private capital has a huge opportunity. And whether or not, you trust, the government, as far as we are concerned, it's about effectively at the micro level being able to asset select those companies who want to take advantage of the market share they can build, in China. And on the other hand, effectively, some Chinese institutions looking at investing abroad, they can do less so, in North America, in the US right now. And that's where we're trying to take advantage of.
You talked about private capital. Private capital fundraising in China actually hit a new low in the second quarter. What would it take to reverse that?
Well, deleveraging. I think that deleveraging, is probably item number one. Then effectively confidence. Investors, need confidence, both way. I think that there are still some part of the market that have not repriced fully. We mentioned real estate, obviously, is a big one. There will be, and whether or not, we see the full effect, there will be some pain, supported, by the market. But like any cycle, and particularly for the fully levered assets, there will come to at some point, you will come to a tipping point, in the value, and that will be the right moment to step back in. That's why, we are trying to get ourselves ready. I mean, Hong Kong is a great market to be following right now. Where only, real estate is always a lagging indicator, because when there is a stock market crash, it happens overnight, right? For the real estate, by the time you swallow all the inventory and the repricing, you need people to be able to take the pain. Real
estate, along with the financial markets, have seen regulatory crackdown. Are you still worried about that?
You cannot really price, regulatory changes, because unfortunately, and we see that across the world. I mean, China is a specific case, but right now, many times we're debating around, the U.S. election and what can happen, one way or another. As asset manager, as risk manager, for us, it always comes down to the asset selection. We own private assets. In that respect, we cannot sell the asset overnight by looking at a quote on Bloomberg. We have to be able to live and every Friday night go home with our all inventories, and for the next 5 to 7 years, live with that. So, real estate as an asset class is one that we've always liked, at Tikehau. It makes up a third of our assets globally. It's still relatively, early here in China, in Singapore. Here we've been managing publicly traded REITs, as a matter of fact, investing in Europe. So we've always looked at taking advantage of the local technology to, once again, best serve our clients.
All right, Mathieu, hang tight. Mathieu Chabran of Tikehau Capital, he is sticking around. Now that the Fed has started cutting interest rates, traders are finding it challenging to place bets on the stock market. The U.S. economy is growing. Equity indexes are hitting all-time highs. Corporate earnings are expected to keep expanding. So, where are investment pros looking instead? Let's bring back Mathieu Chabran, co-founder of Tikehau Capital. First off, 50 basis point cut. Some say it doesn't matter whether it was 25 or 50. Trajectory is it is going lower. How much more are you anticipating?
Well, I would be prepared to challenge that, actually. I'll be prepared to challenge that. I'm based in the US, as Linda, so I can tell you that there is some sticky inflation. There is some sticky inflation. And, this move, the 25, 50, in the grand scheme of things, the reality, as we were saying earlier, is that today we have to operate, once again, as asset owners, asset managers, asset allocators in a world where effectively the risk-free rate is no longer 0%. It's not going back to zero anytime soon, absent any other big external, surprise. And right now we have, once again, to play with that. So do they have room to go further? Obviously, we've got this election, coming up. If I may, I think the Fed has always been a political tool, very different from the ECB, certainly the BOG. We just talked about, China. It's always been a political tool, and there will be a political agenda. Depending on the outcome, of this election. So traders, short-term money manager will have to effectively factor that in. But once again, in the long term, as private manager, it's a blip in the assumption that we have to make.
The thing is, markets are looking at 2.9% by mid-2026. Some say perhaps the Fed could get there much faster. Your take?
I mean, it could, but once again, as we were saying earlier, I think they're just giving you the price of liquidity. Our job, I think the traders you are referring about, our job is to rightly priced the risk premium. And that's a totally different story. Because I think despite all-time highs in the stock market, I don't know whether you will agree with me or not, but we probably are at the all-time risk environment globally, from a macro standpoint, geopolitical. And where is that reflected, in asset valuation? And I think our job, Fed is one component of the overall equation, the base rate is one component, but our job is to properly price the risk premium, and I think that some markets might be mispricing it right now.
All right, so there is currently a divergence in terms of monetary policy. Yes, the Fed is cutting. We have China adding stimulus. We have Japan and Brazil raising rates. Where do you see the opportunities from that divergence?
Well, that's, it's a perfect scenario for asset pickers because you're no longer just buying the trend, you have to do the work. And then that's when you have to do the work that you can be extremely discriminating. Not only in your performance long term, in your client satisfaction, long term, and effectively, yes, people have to come down, to do the work. And once again, for private markets, you have to be multi-local. You just not do Asia from London. You don't do the US, from Singapore, and you need, this footprint. And we kind of like, this environment.
So what are you doing specifically in Asia? When we talk about Asia, of course, we have to draw a distinction. It's a huge market. Yeah. Southeast Asia, for instance. India is the other part of it.
Yeah. So we've been in Singapore 10 years, as I told you, and we picked Singapore as our hub, when we established here. Then moved to Seoul, Korea, to Japan, right now, Hong Kong. And we really had, three objectives. One was, to promote the brand and the investment solution that we could offer to asset owners, in the region, who've been, great allocator to the asset class. The other one was to effectively convert that, in fundraising. And today, starting from zero, it's roughly 10% of our AUM base, coming from the region, with some untapped market that we believe that are going to be contributing. And the last one was effectively to deploy some capital. Now, there's no shortage of capital, and at Tikehau we had no pretension, to challenge, the incumbents. But what we think is that we can bring some expertise, that will be extremely complementary. That's what we've been doing, over the years. I mentioned, real estate. We just announced a few months ago, private credit, which is, big 40, half of our AUM, in credit in some way, shape, or form. We just announced, this partnership here, and in this environment, that's a perfect asset class for investors to compound.
India, it's been euphoric.
Yeah.
It's time for a correction, some say. Yeah. Valuations are just through the roof, 20 times, PE. Like, do you still get in?
I'm back to, my supply demand, imbalance. What you lost in China, you gain in India from a flow standpoint, and somehow, a bit in Japan. But it's a different, it's a different story. So I think everybody agree you had this massive flow of capital. Again, leaving China, getting into India, valuation, once again, it's a relatively closed market, right? In India, despite being a huge market, we at Tikehau played, this market on some minority private equity play in some very significant consumer, I'm thinking, broadcasting typically investment. But to your point, right now it's purely driven by the supply demand and the inflows. One needs to get down, to fundamentals. On a relative basis, India is a very interesting market that we are looking at. But once again, you need to remain extremely discriminating.
All right, better be careful. Overstretched markets. Mathieu, good to have you with us. Mathieu Chabran of Tikehau Capital.